Hey folks, my name is Daniel and welcome back to another video. I hope all of you are doing absolutely phenomenally out there. As always, here today, I want to take you all through 5 stocks that I plan on buying here in 2022. Now, in full transparency, these are all companies that I own as a part of my overall stock market portfolio, and I will cover that individually when we go through these, but kind of my job in this video is to just give you an overview as to what each of these individual companies are, why I'm excited about them from a long-term point of view, and just kind of explain why I'm personally invested in them. Now, if you want to see a different video where I go through stocks that I may potentially buy in terms of new stocks, make sure to hit that like button and subscribe button. And yeah, with that all out of the way, let's get into the video here, folks. So first on the list here, Hims and Hers Health. This is a big position in my portfolio. It makes up, I want to say, just around 17.5% of my portfolio. And it's a company that it's essentially attacking one of the most profitable spaces in the telehealth sector. You look at a company like Teladoc, which focuses in on a lot of business-to-business transactions, where essentially Teladoc partners up with different businesses to essentially give employees the ability to contact doctors online. What Hims does is, again, they're a significantly smaller company at around a $1.17 billion market cap, and what they do is they don't make any money off of their essentially online doctor side of their business, where they're more of a business to consumer company, where consumers can go onto the For Hims website or For Hers website, depending on obviously which gender you are, and connect with different specialized doctors on different topics, whether it be dermatology or hair loss or sexual wellness or even anxiety and depression. Hims and Hers targets pretty much everything. They don't take a cut from that side of their business, and instead they make money off of the high margin prescription based products, and in addition to that, non-prescription based products, which can also help you with your problems. So obviously this is almost more of kind of the same way some pharmaceutical companies or pharmacies, whether it be in the US or Canada, almost give doctors part of their unit at a very, very low rent fee to kind of set up a doctor's office. Hims and Hers is almost the kind of online version of this, where they're connecting you to doctors pretty much at cost, and in return to that, they make a majority of their money from, again, the products that they sell, which their margins on those products are right around 70 to 80%, which is very, very high. Now, again, this company currently is not profitable, and we can actually take a look at this. On the ticker terminal here, we can go to Hims and see, again, right around a $1 billion market cap. It's been getting slammed here over the past year. Ever since they did go public, there was a ton of hype back at the beginning of February when the stock was trading at around $25 per share. But again, I've kind of taken this opportunity over the past few months to really just accumulate a position around this $6, $7 range, to a point where now I'm obviously very, very happy with where I'm at. Now, again, this company is losing money, and they do expect to continue losing money for the next couple of years, but in return for that, you're getting a ton of growth. You're getting a ton of investments into marketing and innovation, growing out their platform, and with a visionary CEO who wants to build this into a massive company, there's a ton of potential here. I also didn't mention this previously, but right around 95% of this company's revenue comes from subscriptions. People buying some hair loss product that obviously helps you with hair loss on a monthly or quarterly basis. That's the beautiful thing about this company. Subscription-based, high margins, and very, very kind of positive longevity, in the sense that customers aren't going to leave after a few months. If you start potentially buying a product and it's working on your hair or it's working on your face, it's helping you with anxiety and depression, there's a big, big chance that you're going to be a customer for years to come. And that's the beautiful thing about this company. I love what they're doing. Now, again, they are losing money. However, when you do actually take a look at their balance sheet, they're poised to be able to continue growing and operating at the rate they are at right now, with just about $250 million in cash and short-term investments, pretty much no liabilities, again, no long-term liabilities, again, on top of that, very, very limited short-term liabilities. So this company has enough capital to continue operating at the pace that they're kind of operating right now for years and years to come, to eventually you do see that switch, and hopefully, obviously, we'll see, again, a positive stock performance. So that's kind of the story behind HIMS, why I'm invested. I have a separate video on them. In addition, 2 separate videos on pretty much all of the companies that I'm going to talk about in this video, and I will leave all of those linked in the description down below. Either way, let's move on to stock number 2, Voyager Digital. Again, this is a company that I've held for just around a year at this point as a part of my portfolio, just around 35%. It is my biggest position, and obviously that does come with risks, but I look at Voyager as a potential huge winner in the fintech space. Now, currently, their kind of main product and value proposition is the Voyager app, where you're able to buy and sell over 70 different cryptocurrencies and earn industry-leading interest rates on all of those cryptos as well. Now, the way they make money is off of the selling and buying of those cryptocurrencies. They're a brokerage, and they connect to over a dozen different exchanges and take a bit of a spread off of each transaction. So obviously, off of that, they make a lot of money and are able to, again, kind of maintain profits despite investing so significantly into marketing, innovation, and just the very, very skilled management team over there at the company, which is now over, I want to say, 250 employees. Now, in addition to this, and here's kind of the big thing about this company, it's that if cryptocurrencies end up succeeding over the next few years, over the next half decade, decade plus, Voyager is going to take significant market share from this emerging industry, as currently they're just a crypto brokerage, but they're expanding internationally into Canada and Europe in the year to come. They're having a debit card get launched within the next few weeks. You have stocks getting launched on their platform very, very soon. And in addition to that, down the road, you'll have products like crypto-backed loans. This company's plan and vision is to be a crypto-backed financial platform. So as long as cryptocurrencies succeed, they're going to be able to thrive within this industry and be one of the big leaders amongst the likes of the Coinbases and the Krakens of the world. So I also forgot to mention the fact that they do own a subsidiary called Coinify, which is involved in the cryptocurrency payment processing industry. So they've already got their toes dipped into a lot of the different parts of the fintech industry. And as long as, again, cryptocurrencies gain traction and actually gain real world application over the next few years, I can expect, and we can expect, big things to come for Voyager as a platform, which is why I personally believe it is, a major opportunity. Look at the banks. They're worth hundreds of billions of dollars in market cap. Voyager's just worth a couple billion. So, and add on top of that the fact that they have right around almost 1.1 million funded accounts, and you really just start to see the story of, hey, this platform, they have potential, and as long as the macro environment favors them, they're going to succeed. And that's just kind of my opinion on all of this. Again, a great balance sheet, same as Hims and Hers, right around $250 million, sitting in cash at this point in time, pretty much no debt, and at this point operating at a positive cash flow. Now, again, one of the risks is a crypto bear market, but that is something that you have to just kind of consider and say, all right, how much am I willing to put into Voyager, with the understanding that we may experience some form of a bear market at some point in the future here, which obviously would limit cryptocurrency trading and decrease their revenues pretty significantly. So either way, I'm very, very optimistic about this one. That there is a chance I do end up lowering my exposure a little bit over the next year, again, just to kind of hedge against that bear market. But again, we'll see what ends up happening. I have no plans of selling at this point, and throughout 2022, this is one that if things change in a massive way, the share price decreases significantly, it's one that I sure as heck plan on buying more of. Now, the next one, Corsair Gaming. This is one that I've been talking about for, I want to say, close to half a year at this point. Now, I've only started to buy this one over the past month or so, and that's because of this divergence that I've personally seen between the company's stock price and the actual fundamentals of the business, which you look at Corsair Gaming, they're a gaming company. They are heavily involved in the hardware space with, headsets, microphones, keyboards, etc. And they do have another branch called called Elgato, which focuses in on creator content and hardware that supports that through things like a ring light, which I use, and a microphone, which I use. So again, this company is an industry leader. They're a leader in their space, and obviously you do have Logitech, but Corsair is more in the premium market. But you look at this company, they have a strong brand, and people are loyal to them. And I think that's the most important thing to understand at this point. So you look at Corsair and you look at the stock price performance over the past year after hitting a high of around $45. Sure, you've seen an exit out of this pandemic, which caused a one-time spike in demand for their products. In addition to that, you have a ton of supply chain shortages and problems that have caused, again, big problems for this company over the past few quarters, but all of that is starting to dissipate. All of those fears, in my opinion, will start to go away over the next year or two, which sets Corsair up for a phenomenal opportunity over the next few years. Again, as long as the macro environment changes positively. And again, we look at Corsair, this company, at least in terms of analyst estimates, is trading at a forward PE of 13. So again, if a lot of this fear subsides, this is easily a 15-20 PE ratio stock. And again, using forward metrics at 13, I think that sets this company up rather phenomenally to be trading at anywhere from around $30 to $35 per share within the next year, and then potentially even more than that over the long run. So again, Corsair, this is a strong brand, a very safe stock in my opinion at this point, as again, it has gotten rid of a lot of the risks. Given that the stock price has fallen so significantly, this one makes up just around 5% of my portfolio, and I'm kind of fine with that. If it does dip rather significantly below $20, I may consider building that up to potentially 8 to 10%. But that's just kind of my thoughts with Corsair. I like the company, I like the branding, and again, I'm very confident with this one in the short term and the long term. Second last on the list, Discovery. Oh, Discovery. This one has been a big winner for us here over the past few weeks. And it's one that I've been talking about for 2 months or so. And, you know, a lot of people, when I made those videos back about Discovery's valuation, were like, Daniel, you're buying Discovery? What the heck? And, you know, to those people, I think it's important to understand that, you know, sometimes investing can be quote unquote boring. And sometimes that's where you make the most amount of money. It's in those boring investments that are overlooked by Wall Street where you can significantly outperform. And what we've seen with Discovery here is the share price in the span of less than 1 month go from around $21.60 to over $30, over a 40% move up in a matter of weeks. And again, this is one that makes up right around 9 to 10% of my portfolio, and it's one that has a cost basis, I think, of around $23. But again, the thing about Discovery, again, I'm sure you all know the content that they do create, a lot of nature shows, science shows, a lot of very interesting things for a very specific, obviously niche and individual group of people. But the major opportunity with Discovery comes from two things. First and foremost, expanding into direct-to-consumer with Discovery Plus, creating that reoccurring revenue business model. And in addition to that, their upcoming merger with Warner Media, which includes HBO. Again, pretty much the third biggest player in the streaming space behind Netflix and Disney Plus. So you kind of put all of these things together. You take a look at the valuation, which I personally believe Discovery is getting this merger at a very cheap valuation. And I think that sets them up very nicely here over the next few weeks. You've had the European Union essentially approve this merger between, again, Discovery and Warner Media. And I think the positivity is just starting. Now, if this stock obviously takes a major dip throughout 2022, potentially back to that $20 range, I could very well see myself adding this one more as, again, it's a very safe play with a big opportunity ahead of them. Now, the biggest risk with this company and with this stock is the fact that they will have high levels of debt. Now, personally, I'm not worried about this because just back in 2017-ish, 2015, just kind of around that time, right around 3 to 5 years ago, they acquired Scripps, and within that kind of transaction, they took on a whole lot of debt. And what did they do? they essentially kind of offloaded a lot of that debt in the years to come and took it down to a much more manageable level. And that tells me that Discovery, from a management team point of view, will be able to handle the debt load that will come with this acquisition here, or I guess you could call it merger, with Warner Media, and that gives me a lot of peace of mind. So again, looking at Discovery here, this is a company that I really, really like, and it's one that I do plan on holding up until it reaches a potentially $40, $50 per share, which at that point, I do think the opportunity starts to get priced in a little bit. But again, fundamentals change with time, and if that situation does end up arising, I will kind of reassess the situation with Discovery and make a video on it. Last stock, Dropbox. This is the first company that I covered on the channel here, and the first video I ever made was on Dropbox. It got like 400 views, which was phenomenal at the time, and really just kind of kickstarted everything for me. Now, the thing about Dropbox is that it went on a pretty massive run ever since I started to talk about and buy this stock. It was around like $18 when I was talking about it, went up to $32, and I was like, man, the opportunity's kind of almost priced out. And what's happened since then? Well, the share price has fallen significantly, and in addition to that, the fundamentals have improved to a point where even though Dropbox is trading above where it was about a year ago, it's the cheapest it's ever been. So, and again, I can actually visualize this here for you using this ticker terminal. And by the way, phenomenal software. The referral link in the description down below if you do want to check it out. It is completely free if you want it to be. They do have a bit of a kind of premium version, which lets you look at 5-year analyst estimates. It's pretty much the cheapest in the investing space from what I've seen. But again, it's what I use. I love it. Feel free to check out the link in the description down below. But either way, again, right around a $9 billion market cap, you take a look at their valuation, and using 2022 numbers, you'll see, again, we can use different metrics here. We can use a PE ratio and see that, again, on an all-time, or I guess on an all-time chart, they used to be unprofitable. We can see that they're trading at pretty much the lowest valuation, right? Yeah, significantly lower than where it was back in May of 2021, February of 2021. You look at, again, you can look at free cash flow as potentially another metric, which I know a lot of people look at. And let's just kind of pull it up right here. We could use, just go free cash flow. And again, very, very similar story from a 3-year point of view. This is the cheapest this company's ever been trading at. So what do I think is happening with Dropbox? And again, this is like a 12 times multiple. This company's growing double digits. Their recurring revenue business model, Dropbox, pretty much everyone knows what they are. Again, involved in the cloud storage space, recurring revenue business model, high margins. I love this company. I love what they're doing. And I think it's a very, very stable play. And again, as long as sentiment returns to this company over the next couple of years, they're set up very, very well to outperform the market in a major way. And I know this probably is the most boring stock out of all of these on the list here, given that it is purely a valuation play. But again, I think it's gotten bundled up with a lot of these, again, small cap tech stocks that have fallen significantly here over the past few months, given this, again, kind of announcement with the change in interest rates by the Fed. And I think that's a bit unwarranted for Dropbox, as again, this is a stable company with stable revenues, stable profits. And again, I love Dropbox. I always have, and it's finally gotten back to that valuation that I really do like. So currently it does make up around 5% of my portfolio, just under that actually. But again, if this is one that potentially falls significantly, it's one that I may add. If it does kind of stay around this range and a lot of other stocks that I do like a little bit more fall significantly, it may be one that I do take cash from. But again, I like it as a stable play, and it's one that I think will have kind of lower volatility from that perspective if we do end up seeing a bit of a up and down market throughout 2022, which is personally what I think will happen. So anyways, guys, thank you all so much for watching this video. I really, really do appreciate it. Again, this is a bit of a different style that I haven't done in quite some time, but it's one that I really do enjoy, and I think it offers insight into kind of what I'm doing and my plan as an investor, which is kind of what was my original goal here on YouTube, and it's one that I plan to explore a little bit more here moving into 2022. So anyways, again, Thanks so much for watching. If you found some value, please consider subscribing and let me know in the comment section down below what your thoughts are on any of the stocks that I talked about and others that you potentially want me to cover moving forward. Thanks so much for watching, and I'll see you all in the next one. Bye-bye. By the way, just a quick note, just clarifying that I'm not a financial advisor. Nothing I say in this video should be considered financial advice. This is all just purely my opinion and my personal plan as to what I'm doing in 2022 when it comes to stocks. So again, with that out of the way, cheers.